Trading can be further categorized as taking place on a cash market or a derivative market. Cash market trading. A cash market, otherwise known as a spot market, is a market where the buyer of an asset receives it immediately after the contract settles. For example, if an investor purchases a stock or a bond, the investor has engaged in a cash market transaction. Derivatives trading. Derivatives are securities derived from underlying securities. A derivative market is a market that trades derivative securities where the two parties agree to transactions whose cash flow are a function of the value of a specified underlying asset in the future. One party has a right and the other party has an obligation. There are many different types of derivatives, including forwards, futures, options, and swaps, and there are specific characteristics in derivatives. I will explain them in a separate session. Volatility trading has become increasingly popular over the years, to the extent that some market participants view volatility as an asset class on its own right. Volatility trading most commonly involves the buying and selling of options on the VIX, which is itself a gauge of volatility derived from call and put options on the S&P 500 index. It can also mean buying and selling of other options, since volatility or implied volatility is a key input in option pricing. Margin trading. Investors may use their own money to purchase a security, or they may borrow part of the purchase price. Margin trading or trading with leverage refers to the practice of borrowing money to purchase securities. Lenders face risk as there is possibility that an investor may not repay the borrowed funds. To mitigate this risk, lenders retain the acquired securities as a collateral. They carefully monitor the value of the securities and work to ensure that the margin account is satisfactory. Any breach of the permitted level or the margin requirement results in a margin call. Note the lending standards tend to tighten when markets become more volatile, meaning that the lenders may demand more margin. Because it allows investors to enter into larger positions than they would otherwise be able to enter into, margin trading enhances both gains and losses. Due to the risks involved, regulators set careful rules and regulations related to margin trading, and some securities are not permitted to be margined. Securities lending. Many institutional investors hold securities in their portfolios that they do not intend to sell quickly. The investors can generate additional revenues by lending out their securities. We'll explain further about securities lending in a separate session. For now, thanks for watching, and I'll see you in the next session.